Hello, everyone. Welcome to episode 4 of 10-Minute Bookkeeping. Revenues are like the lifeblood of an entity, flowing in from its operations. But how should we recognize these revenues? It's a crucial question, and today we'll find the answers. We'll explore the perfect time for recognizing revenues and how to adjust them at the end of a period. Plus, we'll even meet a special kind of revenue called gains. By the end of this episode, you'll be well-versed in accounting for all situations related to revenue generation. So, without further delay, let's get started right away. Revenues should be recognized when products are delivered. This rule applies to both tangible goods like shoes and intangible services like car repairs. You might wonder why revenue is recognized at the time of delivery. Well, it's because accounting is a conservative language that avoids any risk of overstating an entity's net income. Let's consider the example of a car manufacturer. When it receives an order and starts manufacturing the car, but hasn't yet delivered it, it would be risky to recognize the revenue at that time. This is because the customer might change their mind and refuse the delivery. However, when the delivery is accepted, it's very likely the customer won't change their mind, and the deal becomes secure and finalized. Accounting is a language that plays it safe. It waits for the delivery, which reduces the chance of a deal being canceled and ensures that the revenue is recognized when it's more certain and reliable. So keep in mind that revenue recognition is all about product delivery. It can happen before, during, or after receiving cash. Now let's groove through some examples with Ace Company, a toy manufacturer, to get into the rhythm. In the simplest scenario, cash is received at the time of product delivery. On January 1st, Ace received an order from Able Company for some toys. Then, on January 3rd, Ace delivered the toys to Able and received $2,000 simultaneously. Revenues can be categorized based on an entity's activities. Revenue generated from selling products to customers is known as sales revenue. The transaction here is a classic sales revenue. All right. It's your turn to pause the video and make the journal entry for these transactions. Welcome back. How did it go? Receiving an order isn't a sales-making moment in accounting, so no journal entry was needed on January 1st. But on January 3rd, when the toys were delivered, it was time to recognize sales revenue. This revenue arrived with an increase in cash. So here we debit cash and credit sales revenue. Now, let's talk about a credit sale. This is where an entity delivers products, but cash is received later. At the time of product delivery, the entity gains the right to collect cash from the customer. In accounting, we use the term receivable to describe the right to collect cash. It's considered an asset for an entity. For instance, when an entity has the right to collect cash from a customer, it's referred to as account receivable. If it's from a tenant, it's called rent receivable. And when it's from a borrower, we call it interest receivable. These distinctions help keep track of different types of assets related to cash collection. And the accounts receivable is often related to a credit sale. Here is a typical credit sales situation. Ace received another order from Baker. On January 15th, Ace delivered the toys for $3,000 without getting cash up front. But on January 30th, Ace received $3,000 for their performance. Now it's time for you to pause and make journal entries. Let's walk through this together. On January 15th, Ace made a credit sale. The sales revenue should be recognized, along with an increase in the right to collect cash from the customer. So we debit accounts receivable and credit sales revenue. On January 30th, the cash finally arrived, so the account receivable decreased. And this calls for a debit to cash and a credit to accounts receivable. Now, let's move to the last situation. When a customer pays in advance of product delivery, an entity has a commitment to deliver products. This commitment is a liability, specifically known as unearned revenue. Let's apply this to Ace's situation. On January 31st, Ace received an order from Cable and $4,000 in cash for the order. On February 10th, Ace delivered half of the ordered products to Cable. On February 15th, Ace delivered the remaining products to Cable. Now pause the video and give it a shot to record these moves. All right, time to come back. On January 31st, Ace got the cash but hadn't delivered the products yet. The cash increased and so did the liability to its customers, which is called unearned revenue. Here, we debit cash and credit unearned revenue. On February 10th, when Ace delivered half of the products, half of the revenue should be recognized, which amounts to $2,000 while reducing the liability. So we debit unearned revenue by $2,000 and credit sales revenue by the same amount. On February 15th, we should repeat a similar entry to complete the sale. Now it's time to make a summary. Revenues flow into an entity in different forms. Some might bring cash to the entity immediately. Some might give the entity a right to collect cash, like accounts receivable. Some might make its liability, unearned revenues, decrease. But one principle ties it all together. Revenue emerges from the magical moment of product delivery. When an entity delivers goods or services, it's time to pop the confetti, sound the trumpets, and recognize that revenue. All right, let's move on to the next section. We know that revenues should be recognized at the moment of product delivery. But what if, and this is a big what if, the delivery keeps happening every single day? Do you want to recognize revenue daily, or do you wait until the grand finale? The smart practice here is called the end-of-period adjustment, which means to recognize revenue at the end of each accounting period, until the delivery ceases. I'll explain why it's the way to go. Let's look at Base, a consulting company which prepares financial statements monthly. On March 2nd, Base got $6,000 for providing 60 days of consulting services. From March 20 to May 18th, they kept delivering these services. How should we account for these transactions? Well, on March 2nd, Base got paid, but it hadn't done the work yet. The cash was just an unearned revenue at that time. Every day from March 20 to May 18th, Base was hard at work, theoretically making $100 per day. You could go ahead and log that daily. But let's be real. That's like counting grains of sand on the beach. How about recognizing the revenue only at the very end of the service delivery? It's not the solution either. If we wait until May, Base's income statement for March and April would read 0, and May would be a financial roller coaster. That's hardly a fair portrayal of Base's dedication and hard work during those months. So, what's the golden solution? Well, Base should recognize a revenue at the end of each accounting period, matching it to the work put in during that period. In March, $1,200 should be recognized because Base worked for 12 days. April brought in $3,000, and May added another $1,800. The end-of-period adjustment is a time saver for accountants and ensures nothing's left out in financial statements. It's a must-have tool in the accounting toolkit. And guess what? We're just getting started. Now it's time to put all of this into action. Let's continue the story of the Base. They're not just consultants, they're also landlords. From June 11th, Base rented a building out to a tenant for 30 days for $3,000 on credit. It received $3,000 cash from the tenant on August 10th. It's time for you to pause the video and make journal entries for these transactions. Welcome back. The renting activity lasted for a period. The daily revenue for the renting should be $100. In June, Base provided renting service to the tenant for 20 days, so $2,000 of revenue should be recognized. The tenant didn't pay at that time, so the revenue was accompanied by an increase in rent receivable. So we debit rent receivable and credit rental revenue. Similarly, on July 10th, Base should recognize revenue of $1,000 with an increase in rent receivable. In August, when the tenant paid the rent, Base's cash increased and rent receivable decreased. It's simple. We debit cash and credit rent receivable. The key takeaway for this section, the end-of-period adjustment. Remember, it's not just for revenues. It applies to all your accounts. So when you close the books each accounting period, make sure to ask yourself, is there anything left out? Should we make an adjustment to the accounts? This is an accounting maneuver that keeps the financial statements in tip-top shape. And now, let's move on to learning a special kind of revenue. A revenue usually comes from an entity's daily operations. However, there's another category known as gains. These gains are more like occasional bonuses, the icing on the financial cake. They can show up in your books when you least expect them, maybe from a generous donation or selling some assets you didn't even plan to sell. Now, why do we bother separating gains from revenues? We separate gains from revenues to make it easy to tell the steady, everyday earnings apart from occasional or one-time income. This helps people, like investors and analysts, figure out how reliable an entity's money-making is. When it comes to recognizing gains, it happens when an entity fulfills its commitments related to that specific gain. Here's an example. On January 10, the company received $5,000 as a government grant. The condition was that the company had to buy eco-friendly machinery, but they hadn't made that purchase yet. So on that day, the company's cash increased, but it was along with an obligation to buy the machinery. It was only when the company finally bought the machinery on February 20th that the gain was recognized. Remember, just like with regular revenues, recognizing a gain isn't tied to cash. It's about keeping promises and securing financial rights. Congratulations! You've acquired the skills to account for making revenues. It might feel a bit overwhelming at the moment, but with practice, you'll get into the rhythm. In the next episode, we'll cover how to recognize expenses. I'm looking forward to seeing you there.